when you're looking to put new people in a property, you want the most lease exposure at the end of spring, beginning of summer, because that is the most opportunistic time when you can push your rents. And then during, late fall, winter, right now, for example, worst time to have high lease exposure, because people don't like to move during the holidays, and they don't like to move during the middle of the school year, and they don't like to move in the middle of winter.
If you're looking to increase the value of your investment property, I'm telling you, you've come to the right place. Our guest today is Ashley Wilson. She's one of the foremost experts in asset management, and she shares with us numerous strategies of increasing the value of your property. Here are my 3 favorite strategies, but this episode is chock filled with numerous strategies and challenges in the asset management world. Number 1 was when renovating units, incentivize your existing tenant base to move into those recently renovated units so that you can get to work on those recently vacated units right away. This will actually increase your turnaround speed. Number 2 is actually this concept that there are some times of the year that you want people moving in and other times that you don't want people moving in. And so having a lease expiration management system is critical. And then the other thing that really caught my eye was all of the challenges and strategies that go into asset management and turning around the property in those critical first 30 days. Ashley's the co-founder of Bar Down Investments along with her partner, Jay Scott, and has been investing in real estate since 2008. In addition to operating her own investments, Ashley has advised and consulted for many well-known owners in the multifamily industry and is a sought-after speaker on multifamily operations, inclusive of asset and construction management. So without further ado, here's my interview with the one and only Ashley Wilson. Welcome back to episode 44 of the Real Estate Syndicator Live. And if you are looking to increase the value of your properties through asset management strategies, then you've come to the right place, because we've got one of the best asset managers on the planet. Does this for a living, coaches other people, has a great coaching program that I want to at some point talk about, Ashley. But we've got Ashley Wilson in the house. Ashley, thanks so much for joining us, and we're really looking forward to learning how to really take our real estate properties to the next level.
Thank you so much for having me. I'm very excited to be here.
One of the things I did all day today is I went on all social media and basically made the assertion that asset management was the most important skill that any real estate investor, forget about just syndicator, obviously a syndicator needs to know this, but even if you're just investing on your own, you're doing multifamily. Do you agree with that? Do you agree that asset management is the most important skill over sales and underwriting, all that stuff? And if so, why?
Short answer, yes. Of course, I'm very, very biased. Honestly, multifamily and commercial real estate in general is a team sport. So I would love to say that asset management is the most important role, the role that you need to learn first. But in reality, there are so many moving parts to the business. It's a business. I like to say that multifamily, it's not real estate, it's a business with real estate as a bonus. What you're doing is you're buying a business. Your whole evaluation is based on your ability to have that business perform. So in terms of all aspects of a business, you need people to be able to find the deal. You need people to be able to underwrite the deal. You need the capital. You need lawyers to help you. You need tax accountants to help you. You need asset managers, construction managers, vendors, contractors, lenders. All of these components are absolutely necessary. I would say in terms of someone who knows most likely knows all aspects of the business, it would be an asset manager, because an asset manager is really tapped into all aspects of the business. In terms of finding the deal, the asset manager is working hand in hand on, what type of components to look for. In fact, oftentimes when you're defining your buy box goes hand in hand with not only what the underwriter can get from a pro forma basis and project out your returns that are needed, that your equity needs, but also in terms of your actual operations. I work hand in hand with our underwriter because of the fact that there are general principles that are used for underwriting, but in reality, there is a different set of principles. So just case in point, let's say, for example, that you assume $250 a door on a market allocation in your budget when you're underwriting. Well, that's a good maybe starting point, but across 100 units versus 1,000 units, when you extrapolate that, you actually don't need that much money allocated to marketing. And someone who's in asset management would know that. An underwriter kind of just follows a set of general principles because they don't see the day-to-day and they don't execute on it. So another case in point is an asset manager typically manages a portfolio. If you have a portfolio in one given market and you have multiple properties, you know, as an asset manager, you can negotiate with these vendors to get bulk discounts. But an underwriter is just going to write to the metric that they were given, you know, as a starting off point in terms of that asset being a solo asset and not reliant upon other assets in the portfolio.
So, and I think, thank you. And I think you mentioned in there, and by the way, guys, if you've got a question, please drop in the chat. I've got a bunch and hopefully we'll have time for other people's questions. You got so many questions, but if you got a question, please, the whole idea is for you to answer your specific questions. But I've got my own questions, but you mentioned property management just now, just so that we don't leave anybody behind. Sometimes we have some newbies in the house, so welcome. Can you explain a little bit the difference between asset management and property management? I think a lot of times people think it's basically the same thing, or they're not quite clear on the difference between what a property manager does versus what an asset manager would do.
So a property manager, they're answering to the tenant. They're doing the day-to-day. An asset manager is answering to the investor. So in terms of how we govern our decisions and how we manage, it's completely different, because when I look at how the asset is performing, I have certain bottom lines that I need to hit, where property management is dealing with the day-to-day. And oftentimes that ends up being whatever squeaky wheel gets the grease kind of analogy, right? So if you have tenants coming into your office and you're working with an on-site property manager, that on-site property manager is most likely going to want to not have that person come in their office every day. So if they're saying, you know, it'd be really great if the pool had new furniture, that's something that the property manager would probably be in favor of supporting from a budget standpoint. But the asset manager, when they look at their budget, maybe they don't have enough money to allocate for the furniture to be replaced. There are a lot of different nuances too, in terms of what a property management team does. People refer to property management as the collective, meaning not only the on-site property manager, but it could include the leasing agent, the lead maintenance, a porter on the property, a regional who oversees that property, or maybe a portfolio. So you might not necessarily be working with all of the people on site, but a lead who oversees that property, and that's who you connect with on a weekly, I would hope, basis, minimum.
I was going to ask you that. How often do you communicate with your property managers?
They would probably say too much, but I'm a firm believer that communication is the reason businesses succeed and also the reason businesses fail. So we typically communicate with our property management team, unfortunately, every single day. As properties become stabilized, they tend, you know, we could go a couple days, hopefully get to a week communication at a time once it's fully stabilized. But definitely during the repossession, it is at least once a day, if not more.
Hold that thought, because I want to get into this repossession and stabilization. But Drew actually asked a question. Drew's a troublemaker, but he likes to ask, how do you organize your weekly calls with the property managers? Like, who's on the call? Who gets the agenda out? What software, what tools do you use? Can you just go a little bit about the process of how you go about interacting with the property managers?
We operate by having a weekly call. So we have a weekly call, and we either do it at the beginning of the week or the end of the week, but then there is another supporting document that is on the opposite end. So we have now moved we used to do it at the end of the week, but now we've moved our calls to the beginning of the week, and then we get a report at the end of the week as well. So that summarizes what's transpired since the beginning of the week collectively. And then obviously when we have the call at the beginning of the next week, we get an update of what's happened over the weekend. In terms of the agenda, I have a templated agenda that I created years ago. It's been modified a little bit, but it's pretty well encompassing of every aspect that I find important in terms of how to manage the property, and just pertinent issues that I feel that we should always be knowledgeable of as asset managers, because I've since hired an asset manager who manages our properties. I oversee her, but she's really taken on the lead over the past year on our portfolio. And then in terms of who creates the agenda, it's the property management team. So they run the meeting, so to speak. We just give them the information that we want to know in that meeting, but they're providing updates, and then we're working with them to come up with creative solutions. If I could just add one thing about property management, because we're probably going to switch topics now.
Yeah.
So one of my pet peeves is that people really talk so poorly about property management companies. And I think that speaks not to the property management company, but I think it speaks to two deficits. One is someone's vetting process of a property management company, but two is someone's management of that property management company. The underlying issue that I find that people have is they aren't transparent with their business plan and their approach to managing the property. We are extremely transparent, and we've had a very successful track record with our property management company because we are so transparent. I can't tell you how many properties that we have toured where the broker has told us or the seller has told us, be very discreet about visiting this property. We don't want our property management company to know we are thinking about selling. And a lot of people think that way because they think their property management team is going to vacate the property. What they don't realize, though, is that if their property management team is aware of what's going on and the whole business plan, they will help you make decisions to better position the property, A. B, if you incentivize them to stay, they will stay. And C, if they're staying, if they're doing a good job, property managers are extremely savvy and extremely smart, and they know how to game the system. And they know that if they're doing a good job, a new property owner will most likely try to hire them. If they think they aren't doing a good job, that's when they look to, to reposition the staff. But there are a lot of benefits to being very transparent with your property management company. And I think that opens up a better working situation, because it's not like half of your team, which your property management company, whether you want to admit it or not, is an extension of you, and it's a part of your team. Half your team's flying blind. So I really challenge everyone who is having difficulties with their property management company to take a different approach and be more transparent.
Do you vertically integrate, Ashley? Because Nick had a great question, which is what's your opinion on vertically integrating a property management company? Because it sounds like a lot of the issues you just described may be alleviated with just bringing them in-house. And I know that you actually outsource it, but your thoughts on maybe the pros and cons of having your property manager outsourced versus bringing them in and vertically integrating into your company?
I think that you can be successful either way. I don't think that it's one or the other. I think people default and say that they ultimately have to get to vertical integration because of what I've just was talking about. They don't find success working with third-party property management companies, and it's due to the lack of transparency that they have with their business plan with the property management companies. So they default to bringing property management in-house. But what they don't realize is once they bring property management in-house, they're so willing to be transparent with the business plan. So all they've done is just changed how they manage, but that's the only difference, in my opinion, in terms of vertical integration. Personally, I don't want to. I mean, who knows what the future holds, but I really don't want to absorb property management. And the only reason I would look to partnering with someone, but I wouldn't want to be the one overseeing property management. Property management is such a heavily regulated industry. Things are changing constantly, and you open yourself up to a lot of liability if you aren't well versed on what's going on locally. I also think too, the benefit of working with a property management company that is very entrenched in a specific market. Hopefully they're part of the local apartment association as well as the different governing bodies. So they know things, for example, like changes to inspections or permit requirements, that if you're vertically integrated across several markets, it might be more difficult to be really tapped in because you're still, managing multiple markets, and it becomes a bandwidth issue.
Love it. Love it. Matthew had something nice to say, which I'm going to read, but Matthew, thanks for this. He says, this is not taught anywhere, which I think is true. This is very good information. So I got three comments on that. Number one, thank you, Matthew. And I agree with you. Number two, if you're getting value from this video, please hit the like and subscribe button. But more importantly, Ashley, you actually do teach this stuff, right? You have an apartments addicts coaching program, which I love is a 12-step. It's a 12-step program for the apartment addicts. But you want to spend 20 seconds on what that's about?
Yeah, just real quickly, if anyone's interested, we have a coaching program. Jay Scott, who's my partner, and I. It's called Apartment Addicts. And as Mauricio mentioned, it's a 12-step program. When I first got started, I was looking for a coaching program, and I didn't find one that was a robust program. And what I mean by that is every program I was able to identify at the time, and the programs that I see out there today, they focus on how to find properties and how to fund them, raise the equity, but they don't teach you how to run them. So what we wanted to differentiate ourselves, we wanted to do it on two platforms. One is be a more affordable alternative, but be an all-encompassing program that teaches you soup to nuts how to find, fund, and run properties so that you're able to be successful.
Great. And I'll find in a second, I'll drop a link in the chat and also in the video show notes. And seriously, we'd love a like and subscribe. Ashley, for purpose of the next two questions, I wanted to go through these, and then I think some of these will be answered with this, but let's assume you're doing a heavy value add project. You just bought a property, it's a heavy value, which I think what least from what we're seeing from our clients, is what most people are doing these days. Can you talk about maybe the top challenges, maybe talk about the top 5 challenges that you would face within those first 30 days of taking over that property?
The first challenge is once you get a property, once you have the keys, you're walking in the door, and you're getting all of the financials, it's really eye-opening to see how the actual operations were run with the prior ownership group. So what I mean by that is, I can tell you that it's quite common to find some level of fraudulent financials in commercial real estate. That's just the reality of it. Hope I didn't let the cat out of the bag there, but I think everyone in commercial real estate knows this, and it's kind of unspoken. But ultimately, it's at what level of fraud are you dealing with? So there are incremental fudging of financials and hiding expenses below the line type of financials, but then there are just complete omissions. During the first 30 days, you really get an eye-opening look because now you are fully operating the property. There are times when we've taken over the property and the previous owner promised things that were not disclosed upon lease renewal or even new leases that we have to honor. So just getting through those first 30 days and getting everyone on board with how we run things, we hit the ground running. I can tell you that what we accomplish in the first 30 days compared to, I know what other groups accomplish over, in terms of checking the tick boxes, we typically accomplish what people set to accomplish in 30 days in the first week to 2 weeks max. So that's including changing over all the locks, getting all the systems up and running. We have a team fully staffed. So we have interviewed everyone. And if we're keeping people on site, they're going through trainings in advance so that it can hit the ground running. We are changing over if we're repositioning the property in terms of signage and names, and we might even pre-order certain materials and supplies. For example, during COVID, I obviously knew that there was massive shortages but we were still able to execute on our property a full encompassing CapEx plan that most people would probably say would take at least a year and a half without being in COVID, but we could do it in advance. So it's really just lining up everything. Another thing that we do is one of the things that a lot of people don't do is they don't identify lease exposure. So when you look at a general leasing season, it actually mirrors very closely with single family housing. And what I mean by that is if you look at the spring and summer months, you'll see that housing sales across the country tick up during those periods of time. Why do they tick up? Well, one could argue that it's good weather. People like moving in good weather, but the ultimate culprit is due to seasonality with schools. So most people tend to move during non-school seasons, and that's at the tail end of the spring going into the summer months. Leasing season mirrors identical to the single family housing sales. So when you're looking to put new people in a property, you want the most lease exposure at the end of spring, beginning of summer, because that is the most opportunistic time when you can push your rents. And then during, the late fall, winter, right now, for example, worst time to have high lease exposure because people don't like to move during the holidays and they don't like to move during the middle of the school year and they don't like to move in the middle of winter. So you're not going to be able to push your rents. You have high lease exposure during this period of time. You're going to have a hard time rebuilding. So one of the things we do is we like to have a lease expiration management system across all of our properties. And we actually have it by the week. So we don't have any single week with high exposure. Oftentimes people will say, oh, just for January, I want low exposure, but July I'll have high exposure. We don't do it like that. We allocate it by the week. And if someone's coming up for a renewal, they might not be able to renew 12 months out. We might be able to renew them 11 months out or 13 months out, but all the slots might be filled for 12 months. So that typically takes us about a year to cycle through getting everyone on the right, plan in terms of our lease exposure management system. But that's another thing that we do. So I don't know if I've done 5 yet.
I think you're good.
Just kind of rolling with it.
No, I think you're good. But definitely talk about. So that's kind of what some of the challenges and some of the strategies you use right when you get the keys. What about once you've kind of gotten in there for a little bit? You've been in there for 6 to 12 months. Does that look? What are there different challenges that you're facing? 6 months, 12 months, 18 months in?
Yeah. So in day one, we actually arrive on the property and we have our entire contracting crew there to walk through to reconfirm all the estimates that we had during DD period to shore up our CapEx schedule. And we're deploying our teams right away. So when you're looking at 6 months in, you're looking at maybe some projects that are still going on. So balancing those projects and also balancing depending on what market you're in, you might still be dealing with legacy tenants, and legacy tenants might have some aging delinquency. So you're trying to get rid of aging delinquency as quickly as possible so you can get new paying tenants in beds. So that's something that we work on. We also are constantly adjusting based off of what we're facing at that time. So let's say, for example, we come in with this game plan and we say, all right, we're going to be able to push our 3 bedrooms by $200 and our 2 bedrooms by $100. And we get in and what we realize is more people want the 2 bedrooms than the 3 bedrooms. So we can actually push those 2 bedrooms a little bit more, and the 3 bedrooms we curtail what we're trying to do. We might change up our whole renovation plan just based off of that. We have a property currently where we did exactly that. We thought we'd have to push the renovations more, but because of COVID and the shortage of properties, and also the city took over a couple properties near this one property, which limited the supply. So right away, the demand shoots up because the supply is shortened. So once that happens, that could change your game plan altogether. And then there are other things. For example, on another property, we have a 1-bedroom and a den where we had this game plan where we were going to renovate at approximately $6,000 a door. And we realized all we have to do is put a $300 bifold door on the den. And now we can get the same rental gain as if we had put in $6,000 into the unit. So now none of the 1-bedrooms in a den are getting the $6,000 makeover. They're getting a $300 makeover, and we're getting $150 rental gain, which in 2 months pays it back just on the cash flow alone, let alone the NOI that it's going to build for the property, which is millions in change of NOI. So.
Yeah. Speaking of renovation, one of my favorite strategies I heard you talk about one time is as you finish renovating some of your units, you actually try and incentivize existing tenants to move into those renovated units so that you can work on the unrenovated units of the tenant. Could you go a little bit about that? Because I thought that was a very interesting strategy.
Most people have a reposition of 2 to 3 years. My goal is 1.5 years. So you might say that's impossible because the average renewal rate is 50%. So even if you use that 50% of the property is going to not renew, so you can renovate those units. And then the next year, you're just lucky and get the other grouping of tenants to move out, then it would still take you a little over 2 years to be able to do it. But what we do is exactly what you mentioned. So not only do we offer a incentive by like a move-in bonus or resetting their lease, even because that might help us with the lease expiration management system if we can renew their lease when we need it. But we also will even throw in move-in charges, so our move-in comps. So we'll even help pay for the movers to get them to move into the renovated unit. The reason being is even if we take a little bit of a haircut on the renovation, we don't push it to the max value that we had underwritten. What it does is it frees up another unit that we can renovate faster than what we originally had planned, which if you look at it in terms of a marathon instead of just, a little race, that overall gets the value up higher faster, gets us cash flowing faster, gets more renovated units faster. The NAA came out a few months ago and stated that the average vacant unit costs anywhere between $5,000 to $10,000. And at first I was a little shocked by that statistic, but then when you break it down, it makes sense, right? So you not only have the actual turn costs, so paint, flooring if it's needed, but you also have the vacancy days, so the days that the unit is sitting unrented. But the other things that you have that people don't factor in is you also have marketing spend, and you also have the salary that's allocated by the leasing agent to rent these units. So it adds up pretty quickly. So if you're able to control that variable a little bit more, in the sense that you can have less days on market of a renovated unit and shift that vacancy exposure over to units that aren't renovated and push those further, you can close the gap on your vacancy on renovated units and pre-lease units that are renovated, because you can control better when they're becoming vacant.
That's great stuff. Donna says Ashley runs a tight ship, very knowledgeable and experienced. I agree. Drew had a question that I also had, so I'm going to ask Drew Pitcher's question. Which can you talk about maybe your top 5 KPIs you're watching when you're managing the asset?
So KPI, the first KPI I'm watching is the investor return, the cash flow. So most people think of NOI first, but to me, the cash flow tells the whole story. So that's number 1 is what I'm looking at. Number 2 is I'm looking at my NOI. And number 3 is I'm looking at all my below the line expenses. I do look at occupancy and delinquency trends. But in terms of if I'm, only able to get 3 statistics or three data points, and I have to govern decisions off of them, those would be the 3 three data points I would look at.
Cool. I want to transition a little bit to curveballs. Every so often, the market sends us some unforeseen circumstances, either the market or just some circumstances like COVID. They throw you a curveball. We were talking a little bit about best practices to successfully pivot when those curveballs are thrown. Any strategies or best practices for those pivots?
There are a couple things. One is thinking outside the box. So sometimes we get so ingrained in what we're doing, we forget that we're in a living, breathing community. And what I mean by that is with COVID, one of the things we did with one of the properties we had is when COVID happened and a lot of restaurants were closing down, we went to a small pizza shop and we said, what day is your least busiest day, the least amount of sales? And they gave us a date. Let's say it was a Tuesday. And we said, okay, will you offer a $5 discount on your orders to our property if we pass that savings on to our community? And they said yes. So, that involves having one delivery driver because it's going to the same property, and it pushes business to a small business owner. So hopefully their doors don't close. And then it also helps our community out in terms of they're getting a discount maybe when, cash is tight. So what we try to do is we try to constantly think of ideas that are not just the typical idea that everyone is doing. Right now, for example, on one of our properties, we're working with the Catholic churches to have Ukraine refugees on our property. And that's something, I'm sure anyone could actually execute, but how many people are thinking of doing that? And that's taking what's going on in the world today and seeing how you can help, and also how it can help the property. Our property, we're helping these Ukrainian refugees. We're also now working with them a step further and helping them with job placements. So we've asked for a list of all of the industries that they worked on, and we're going to see if we can connect them through our investors. We're going to send this list out to our investors to see if anyone is willing to step up and help. It's amazing how many people will help if you just give them the opportunity to. So we're doing things like that. With respect to COVID and the changes that we had with COVID and the curveballs, one of the things that I think everyone saw over, the past few years is that COVID had such a V-shaped curve in terms of the sales in multifamily. So if you were watching it closely, you would position your property to sell as fast as possible, seeing just the craziness that was going on in terms of people paying unprecedented prices and cap rate compression, and interest rates were still low at the time. So we had a property that was projected to be a 10-year hold, and we sold it in 2.5 years to maximize the environment that we were in, the cap rate environment that we were in at the time. So sometimes you can't think of, I'm going to create this business plan and this is everything I'm going to do from the day we take over the property to the day we sell the property, because there's so many things that come up, and you just have to be really nimble and just constantly ask other people what they're doing and figure out what makes the most amount of sense for you. But surround yourself with people who have been at this game for a longer period of time to learn from them. There's a gentleman that I always call whenever I have a question, and he's just great to talk things through because he's been doing this for 25 years. So he's been my mentor to help me through any sort of asset management challenges that I have, because he's just so willing to be transparent and share his experience.
It's good. I'm not sure this is a curveball, but obviously things have in the market, and everything's been changing here probably since earlier this year. And I know your partner and our good friend Jay Scott's really into macro, and he's got his pulse on kind of everything like that. You guys talked about something interesting at one of the retreats we were at about you polling your investors, actually talking to them probably more now than ever about what it is they want. Talk a little bit about that process and how you're actually pivoting or changing your strategy. In fact, you guys, I don't know if you already filled it up, but you've got a fund, the Protected Equity Fund, that I think came from this pivot where you're talking to your investors, you're realizing what your investors want today is not completely different, but very different from what it was back in March and April and May of even this year. Talk about that process of talking to investors and then creating really a product or a fund that tailors to that pivoted need.
So I've always said there's two types of investors. There are wealth building and capital preservation. And most of the investors that we have had historically have been on this wealth building mindset. They're open to higher risk, higher reward. I think a lot of that had to do with someone's personal appetite, but I also think a lot of it had to do with the market and the influence of the market in terms of their risk. The market is booming, is very frothy. So a lot of people who might be more conservative by nature were all of a sudden wanting to take on more risk. What we realized by doing these surveys, and we do them about every other month, is that the appetite started to shift. So what we saw was that investors were now looking for something that was less risk, more stable cash flow. They weren't very interested, or I wouldn't say weren't interested, but they weren't as interested as they were historically on upside, because they were more interested in protecting what they already had. And a lot of people were, we made a lot of money during this period of the market. Now we're in a different market cycle. So we want to change up our strategy a bit. And because of that, we created a new product. And it was also in combination with the fact that when we get approached by investors who tell us they only want to invest with us, we spend the next 15 minutes telling them why that's a bad idea and that they should diversify across different asset managers, and teams and different markets and different asset classes. Well, then we would get asked the follow-up question, well, what do you guys invest in? What do you guys do to be diversified? And Jay and I actually invest a lot together. And we invest in a lot of different assets across a lot of different markets and a lot of different asset types. So we were brainstorming and, we're taking this information that our investors are telling us this is the product they want, and then coupled with the fact that they want this diversification, and we created the pref fund. So the pref fund is preferred equity. It comes, so in terms of the capital stack, you have the debt, so the mortgage, and then you typically have common equity. But where we slot in with the pref equity fund is we slot in between. So it's treated almost like debt, where it's a coupon, but it's not, it doesn't participate in the upside. So, and it's still equity, it's not debt, but we have a couple more slots open. It is for accredited investors only. So far, that has been our strategy all along, is just with accredited investors only. I don't know if we'll ever change that, but for now, in the immediate future, we are just focused on that. But our first asset in that fund closes in January this month.
That's awesome. And I've actually thought about having a debate, because you're very, what's the word I'm looking for? It's lack of a better word. You're gung-ho about doing accredited only 506C offerings. And then I've got some other clients, obviously, who are big into 506B. And so it's almost like it'd be fun to have a panel or kind of a debate or something about the 506B crown and the 506C. So maybe.
I'm game. And you could have used the word opinionated. I wouldn't have minded.
I couldn't find that. I think that's the word I was looking for.
I'm pretty opinionated, so.
Matthew's asking, how often do you actually correspond with your investors? But I think you mentioned it in that last little spiel there, that it's about today, it's weekly. Is that where you're at? No, every other week.
So in terms of the survey, we do the survey every other month. In terms of our investors, we have a newsletter. Jay puts out a newsletter every Tuesday. It just came out today. If you are not subscribed to it, I highly recommend reading it. It's free. It's packed with incredible info. I read it every week. I'm like, wow, I can't believe he's my partner.
What's the name of the newsletter? Let's put it in the show notes.
So if you go to bardowninvestments.com, you can just sign up for it right on the homepage. It's at the bottom of the homepage. And then we have a monthly newsletter, which speaks to what we're doing at Bar Down. But in terms of the communications, what's going on with the economy, Jay covers it on a weekly basis in that newsletter. So it's pretty thorough.
Yeah, and I should have the number, but Jay was also on one of our lives probably 2 or 3 months ago. So it's probably in the 30s, episode 30s or something, if you guys want to check it out. I should have asked this before when you were talking about the repositioning, but Drew had a great question, which was any tips for managing a reposition that we don't project will cash flow for the first 12 months? I'm not sure if you play in that world, but any particulars to watch out? Let's start with that. Not advice, any suggested strategies of dealing with those scenarios?
There are two approaches that you can take with this. One is that you are just very transparent with your investors and say, you know, we aren't cash flowing in the first 12 months of this property. And some investors will be totally fine with that, especially if there's additional upside. It mirrors very closely with new development. New development doesn't cash flow either. But that also has greater upside. So what you'll find, as a passive investor or an active investor looking for different asset classes, is the higher the risk, the higher reward. So if you're looking for, something with high risk, you're going to go to new construction because new construction has that higher risk and no cash flow along the way. With respect to an alternative way, which has actually become more common over the past, I would say 2 years in multifamily, is that people are over raising to cover the deficit. And then they're using operational reserves to pay cash flow in the beginning to supplement those shortages. I've seen that quite commonly across a lot of different offerings. And it's become so common that, I think it's also a reflection of the meat that's left on the bone in multifamily. It's getting thinner and thinner in terms of those beginning years of the margins. So that's an alternative strategy that you could use.
Yeah, we see that quite a bit. And again, the rule is basically, as long as you got to be super careful about disclosing that that's what you're doing. But as long as we always say, as long as you disclose it, you can do, from a legal perspective anyway, pretty much whatever you want. I want to talk about, I just saw you not too long ago, a couple months ago down in at the Bigger Pockets conference here in San Diego. And you gave a talk there where, it was it was an amazing talk, but it was kind of controversial. You had very strong opinions about the fact that many operators are really getting bailed out by the market, right? If you look at their pro formas, I think your argument was, if you look at their pro formas of actual returns to their investors, they're all hitting out of the park. They're all doing well. But if you start looking and taking a really closer look under the hood as to, did they actually hit their pro forma NOI, for example? Did they hit their occupancy? If you really look under the hood of those pro formas, a lot of the operators weren't actually hitting those pro formas, but rather were, benefiting from the cap rate compression. You want to talk about that? Because I know you've got your opinions on it. I'd love to hear it, because I thought it was a fascinating argument and a really good one to know, especially going into an environment where those cap rates most likely aren't going to be compressing. In fact, I don't know if you agree with this or not, but I was spent some time with Ken Mack the other day, and he was telling me that basically everything's 20% discounted right now from the highs of earlier this year. So
Absolutely.
Cap rates are actually going higher. So it sounds like a lot of operators who were relying on the market, when you look under the hood, the numbers weren't quite as good. Can you give us the 10-second version of that 2-hour speech you gave?
I can actually do one better if I'm able to share my screen.
I think I can allow you to share a screen here. Let's see, let's do that. You got it?
Yes, sir. So here you go.
Look at this. We're gonna have to somehow, we'll figure that out. Yep, go ahead.
So I'll just share what I shared, part of what I shared at Bigger Pockets here. So if you look, this is a sensitivity analysis table. We put this on all of our offerings. So what you're looking at here is on the x-axis, you're looking at the NOI, so net operating income. That's the performance of the property. On the y-axis, you're looking at the cap rate. So if you had an investment and it was projecting a 13.97 return, that means you were right on target on your NOI. So you operated exactly how you performed the property to be, and you projected a 4.75 cap. During COVID, what we saw is a compression of cap rates. So we saw such a compression of cap rates that we were able to look at something like a 4.75, and all of a sudden that market is down to, let's say it is a 3.25, or let's say, for example, that it's a 3.75. It doesn't really matter, but what it's showing you is that you could have underperformed your pro forma by 8% on the NOI, but the cap rate is really what got you that 20+ return. And a lot of people are, saying, oh, I just did this investment and it returned a 20+ IRR or greater than that. But out of this room of approximately 400 people at Bigger Pockets, when I surveyed the audience and I said, how many people have exited a deal in the past 2 years with, 20+% IRR, what I saw was the follow-up question, how many people asked for original pro forma projections of NOI and cap rate versus actual. Only 200 people out of the 75% who initially raised their hands still had their hands up. And the takeaway message is that people don't question things when things are presumed to be going right. But what you should also recognize is that with the cap rate expansion that we're seeing today, it is not uncommon for a market that was during COVID at a 4.75 cap to be at a 5.5 cap rate. So what that means, if you look at it in terms of sensitivity analysis, is someone has to overperform the operations by 8% just to get a 12.14 IRR. So cap rate expansion has a pretty significant impact on how well you have to perform on the NOI. It's not even performing to NOI projections, it's outperforming those projections just by that expansion. And I think what we'll see today is a lot of people, and I'll stop sharing now, a lot of people can't exit because of that fact. They can't refinance, they can't exit. And then to add insult to injury, they got a loan under variable interest, which is very, very common over the past few years due to the low interest rates. I'm not perfect either. I'll share an error that we made. And that is when we purchased our property, we purchased under a variable interest rate, and we got a 3-year 1% strike on the interest rate cap, which means that if the interest rate goes above 1%, what the originated interest rate is, then we get reimbursed for that. But what it also does is that just like a lender accrues taxes and they accrue insurance, they also accrue what you're going to need to spend on your rate cap. And we're arguing this right now because our loan terms state that we only are required to buy a 1-year rate cap at the same rate, but they're accruing for 3 years because that's what we initially bought. So just to put it in perspective, we spent $30,000 on our rate cap for a 3-year rate cap in September of 2020. That same rate cap today, because I get the rate cap report every single morning at 5:30 a.m., is $465,000. So they are accruing as if we are going to spend $465,000 next summer on our rate cap. Now, the good news is that the interest rates hopefully will stabilize or come down, and rate caps, the way they are determined is that it's based off of volatility. So what I mean by that is if we buy a 1-year rate cap versus a 3-year rate cap, 3 years so much more expensive. It's not 3 times as expensive because 3-year out projections are a lot more uncertain than 1 year. So that's why it makes it so much more expensive than if we were just accruing for a 1-year rate cap. That's a lesson we learned. Fortunately, we have significant reserves, and we should be completely fine, barring no crazy catastrophe, but it is something that has been very challenging because we started off, the lender required us to accrue $303 a month in October of 2021 because they do 6 months assessments. They changed it to $1,100 a month. In April of 2022, they changed it to $9,200 a month, which I thought was crazy. But the week of Bigger Pockets, 2 days before I was at Bigger Pockets, I got a notice that they were changing it to $54,000 a month in accrual. So that hits our cash flow. I mean, that really just impacts our net cash at the end of the day. So even though that money isn't going away, we haven't spent that money, it's just being held by the bank. It definitely taps into the liquid cash that we have on hand.
Yeah, I know that the cap rates are just, it's been a huge topic in the multifamily world in 2022. Actually, I've kept you probably longer than I originally had thought, but really, really appreciate your time today. Who was it? Jennifer was asking about any recommendations of social media groups or the resources. I would highly recommend you follow Ashley on LinkedIn specifically. I'm sure she's on other platforms, but she puts out some amazing, not every day, not like me, it's like once a week, but it's so good, really detailed, very thoughtful. So I would highly recommend you guys follow Ashley. And Ashley, where else should people find you if they're looking to get in touch with you?
Yes, so you can find me on Instagram at Badash Investor. So that's BADASH Investor. And LinkedIn is probably where I post the most amount of in-depth multifamily. It's been a bit on hold, as you probably noticed, Mauricio, because I'm in the middle of writing a book on multifamily, which hopefully one day will come out. It's more like a dissertation at this point. It is very, very heavy on data. So
I can only imagine. And I see there's already requests in the chat for you to come back for a third time. Actually, this is already your second time. You're the first repeat guest, and people are already clamoring for a third, which we will absolutely do. Maybe we'll do that 506B versus 506C. But did we ever figure out? I know Jay Scott, your partner's got a couple of events coming up specifically in Sarasota. Anybody in Sarasota or close to Sarasota that's here? And if not, if you're listening or watching on the YouTube, Jay Scott's got 2 live events coming up in Sarasota. Did we figure that out?
Hold on one second.
If not, you know what? If you've got it, it's great. If not, I'll just post it in I'll post it in the Real Estate Syndicator community. Our good friend, unless Jay's on, which I'm not sure he is. But anyway, Sebastian's in Tampa. Cool. So we'll yeah, go ahead.
Yep, it's on Eventbrite. If you search for, yes, if you search for it. Sorry, the links I was sent were
so they could just probably put Jay Scott. They could just put Jay Scott event or something.
Jay Scott, yeah. And it's on January 21st at the Aloft Hotel. And there are 2 different events. One is for apartment addicts, and one is for Bar Down Investments. Bar Down Investments is if you're interested in passive investing, and Apartment Addicts is if you're interested in our coaching program and being an active investor in multifamily.
That's something. I am going to finish up with one last comment from Jennifer, which is not to be all feministy or anything, but it really is great to see such strong women kicking butt in the male-dominated field. You actually write, you told me not to promote it, but you wrote a book about this called, I think it's called The Only Woman in the Room, a collection of stories from you and other great women. So if you're interested in that, I would highly recommend getting that on Amazon. Thank you, Jennifer, for the kind comments. Ashley is absolutely a kick butter. We love her here at Premier Law Group, and we'll definitely have her on for a third time. We'll figure out whether we'll do it one-on-one or we'll do a little debate style, which I'm looking to do here in 2023. So anyway, Ashley, again, thanks so much for your time. Really appreciate it. Thank you so much for all the value that you not only gave today, but you've constantly given value on our Real Estate Syndicator lives and our community. So really, really appreciate it. Thank you so much. And I'm sure I will see you soon, my friend. And for the rest of you, thanks for coming. And we will see you next Tuesday. Thanks, everyone.
Thank you, everyone.